How property influences the economy. Property is more than just somewhere to live. In many countries, housing is one of the largest parts of the economy. Homes are assets. They are collateral for loans. They influence banks, governments, spending, and financial stability. In this video, we'll explain how property influences the economy both positively and negatively, using real examples from Australia, the United States, Canada, and the United Kingdom. Let's start simple. When homes are built, money moves. Builders are paid, materials are purchased, tradespeople work. Construction is a meaningful part of GDP in advanced economies. In Australia, construction contributes about 7% of GDP, according to the Australian Bureau of Statistics. In the United Kingdom, construction contributes roughly 6 to 7% of GDP. In the United States, residential construction accounts for around 4 to 5% of GDP. In Canada, construction and related real estate services together represent over 10% of GDP. When housing activity rises, economic activity often rises with it. But property does more than create jobs. It creates wealth effects. Over the past decade, house prices have risen sharply. According to the Australian Bureau of Statistics, average house prices increased by roughly 80% between 2013 and 2023. In Canada, data from the Canadian Real Estate Association shows prices rising about 77% over a similar period. In the United States, the Federal Housing Finance Agency reports national home prices increased around 50% over 10 years. In the United Kingdom, the UK House Price Index shows prices rising more than 60% over the past decade. When home values rise, homeowners often feel wealthier. Economists call this the wealth effect. When people feel wealthier, they tend to spend more. That supports broader economic growth. But housing is also deeply connected to banks. Mortgages are one of the largest categories of lending. In Canada, mortgages account for roughly 60% of outstanding bank loans. In Australia, housing loans represent close to 60% of total bank lending. In the United Kingdom, mortgage lending makes up around half of household credit. In the United States, housing-related loans account for roughly 45 to 50% of total consumer lending. This means the stability of banks is closely tied to property markets. If house prices fall sharply and borrowers default, banks face losses. The 2008 financial crisis began in the United States when falling home prices led to mortgage defaults, which then spread through the global financial system. Property also affects household debt. According to the OECD, household debt as a percentage of disposable income is around 180% in Australia and close to 170% in Canada. In the United Kingdom, it is around 140%, and in the United States, about 105%. In simple terms, in Australia, households owe about $180 for every $100 they earn after tax. High debt makes economies sensitive to interest rates. When rates rise, mortgage repayments increase. Higher repayments reduce disposable income. Lower income reduces spending. That can slow economic growth. Governments are also exposed to housing. In the United States, local governments rely heavily on property taxes. In Australia, state governments collect significant revenue from stamp duties. When property markets are strong, government revenue rises. When housing slows, budgets tighten. There are long-term trade-offs too. If house prices rise much faster than wages, affordability declines. In Australia, Canada, and the UK, price-to-income ratios have increased significantly over the past decade. This can increase inequality and reduce social mobility. Some economists argue that when too much capital flows into housing rather than businesses or innovation, long-term productivity may suffer. So is property good or bad for the economy? The answer is both. Property supports jobs, spending, banking stability, and government revenue. But excessive housing booms can increase debt, financial risk, and inequality. In Australia, the United States, Canada, and the United Kingdom, housing is deeply embedded in the economic system. When property markets are stable and aligned with incomes, they support sustainable growth. When they become overextended, they can amplify economic stress. Property is not just real estate. It is a central pillar of modern economies. If you found this explanation useful, consider subscribing. This channel explores how economic, business, and investment systems work and why they behave the way they do.